Good morning or good afternoon to all of you, no matter where you are in the world. Welcome back to another session of Market Mondays. Back here once again to talk about markets, what's been going on, and of course, what to watch out for in the week ahead. We've got a very busy week ahead. Key risk event this week, which will be the Federal Reserve meeting on Wednesday, something that markets have been gearing up to for a while now, and a lot to watch out for heading into it, specifically around volatility and expectations, which are currently priced in just around 90%. But of course, we'll go into that all in just a second. We have to get through the mandatory risk warning as always. Kyle, if you want to put up the slides for us, if you have them just there, just so our viewers can, of course, see that risk warning. And as always, guys, if you have any questions, anything you want to know, you want us to talk about throughout the session, feel free to put them in the question box or in the chat box down below. We will try and get through them as we go through the webinar. And this will be recorded and, of course, posted on YouTube as every week. So you can always go back and rewatch it if you're interested to see something that we've been through. Kyle, good morning. Take it away.
Good morning. Thank you. I'll just get the slides up just with the risk warning very quickly. So apologies for the delay. I was having trouble finding seating space in the office here. But search up store. Oh, great. Let's just have a look. It looks like I need to resubscribe to uh, get Adobe for some reason, so I
All
can't
right. Let
show
me just,
the new
I'm sure
slides.
I can share them. 2 secs.
Yeah, thank you. It's very strange and very annoying. I'll just verbally just begin with it, which is just to say that all the information here is of a general nature only and doesn't take into consideration anybody's personal circumstances. So please seek out your own financial advice if you require it. And of course, consider your own risk appetite because CFDs are risky products. Danny, also, there is just the spread betting element to add to that too, of course, if you're in the UK.
Yeah, just be aware, again, as Kyle said, the products we do offer at Capital.com do carry a high level of risk. So make sure that you're aware of this risk and you understand the product before trading them with Capital. And just so you know that all of the information provided here is of general information. It's general knowledge only. It's not to be taken as investment advice, nor does it take into account anyone's personal circumstances.
Indeed. You gave a pretty good rundown there to start with, Danny, just in terms of what we're going to be covering off. So we may as well just, I guess, continue the conversation. And maybe we'll throw it back to you just for the sake of harmony. But you go first. What will the Fed do this week? And what do you think the Fed will say? Will
Yeah, a
it
lot of the
be
questions I've had heading into this week is, do we expect a lot of change? Because obviously we get the updated economic projections from the Federal Reserve. Do we expect much change on, all the variables, inflation, GDP, terminal rates, heading into 2026? I think it's a tough one to answer because you have to think that we come from a period where there's been a lack of significant data, a lack of updated data that's given both markets, but also the central bank, any insight into how the economy has played out. Yes, there's private data and surveys data which has come through, and again, showing somewhat resilience in the economy, a little bit of concern potentially in the manufacturing and services sector when it comes to those PMI readings. So clearly the economy is softening as is expected, but is it the case of, do we expect the projected GDP, for example, towards 2026 to have changed significantly? Inflation, we had that PCE data on Friday, which was delayed a little bit below expectations, but again, nothing major, around 2.7, 2.8%, still too high when you're comparing it to that 2% threshold, but not high enough, I think, to keep rates on hold and to change meaningfully the outlook of rates going forward. So I think we're in a little bit of a limbo phase right now where I don't think there's been enough substantive data to really change some of these projections. That doesn't mean there may be a small tweak here or there, but I don't think anything major is going to change in terms of the economic projections, the dot plot as well. Of course, you have to think Powell and his team are aware that there's going to be a change in leadership next year in the second quarter. And of course, that may change significantly the outlook for terminal rates heading forward. So I don't think they'll be any major changes just yet. I think they're going to be very cautious about striking a balancing tone, especially as markets continue to price in now just under 90% chance that we cut in December. Now, as we've said for a few times, Carl, if we think back to that September meeting when Powell pretty much said that, a December cut is not a done deal, he was trying to give himself and the central bank room to act and a little bit more wiggle room, some optionality, which markets had kind of taken away from them because they were so heavily inclined towards continuous rate cuts in the end of 2025, heading into 2026. That gave markets a little bit of a pause for thought. They readjusted their expectations, but now we're right back where we were once again with this December meeting. Again, not giving the central bank much optionality not to cut. I did get a question from a reporter whether I think there's any chance they could potentially not or decide not to cut rates this week. I think it would be a high risk for the markets. I think it would be a shock, and I think it would probably induce too much volatility, which is something that the central bank would be uncomfortable with. And again, that doesn't mean there's no chance that they may do that. At the end of the day, they could potentially decide to not cut rates. If they were to do that, I think it would be focused mostly on inflation. As I said, the data isn't awful. It's not too high, but it's still much higher than they would like. So could they potentially go down that road? I think the chances are very small. If they were, I think it would be to rebalance those expectations in markets. Once again, kind of striking a point that they can, that they still control the narrative and that it's still a dual mandate that they're looking at. And while markets have been mostly focused on employment, it could be a message to be like, by the way, inflation still matters, and we're still not sure that we're comfortable continuing to cutting rates given at the rate it's at. Kyle, what's your view on that?
So my first headline, top line kind of perspective is I reckon they'll cut rates. I think you would have had more pushback going into the blackout period on the chances of a rate cut if they weren't going to at least cut rates, because clearly market pricing had sort of moved in the direction of another cut, thanks to some fairly dovish commentary from what we had Williams and Waller, I think, just before the blackout period. The next kind of thing that I think the markets are betting on is that the Fed is going to take the path of least regret, as it always does, and that in this particular instance, in the absence of a lot of data that the Fed normally relies on to set rates, that the path of least regret is to cut rates by 25 basis points and then reassess the situation when there's more data available over the summer going into the next meeting, which will be at the end of January. The next question then becomes what will be the complexion of the rate cut? And this is where I think it will be something of a hawkish cut because of the lack of data and because of what the Fed said at its last decision, that there is still two-sided risks to the US economy. Yes, the employment market is a bit softer than perhaps previous points in the cycle, if we sort of map the cycle over the last sort of 2 years or so, where the US economy sort of reaccelerated again after a period of higher interest rates. There is that element to it. There is the element to it as well that inflation is still fairly persistent. And although the data we got on Friday night Friday was not too bad, it was out of date. It also continues to show that inflation remains anchored around the high twos or so, suggesting that maybe things aren't reaccelerating for now, although there are significant inflationary risks coming down the pipeline because of the sort of fiscal spend that we're going to see from the Trump administration next year. That suggests that you can't be cutting interest rates aggressively, at least without considering the impacts that might have on inflation going into next year. And so I think it's going to be a kind of like I said, a hawkish cut. The question becomes how do markets react to that, and where the detail will be found to sort of determine whether it's a hawkish cut or not, certainly versus expectations. And maybe what I will do now is just take the screen from you if I can, because I was just going to get more or less that pricing up that you've got at the moment, but then also perhaps overlay it with just a look at the Fed's previous projections. Can you see that, Danny, by any chance? Just the my screen now.
Yeah.
First, so obviously we just spoke about the 87% implied probability of a cut. We're going back to that CME FedWatch tool that we have gone to in the past, and of course, encourage people to sort of check out as a very publicly available resource to look at Fed expectations. But if you just look through the, let's just go, hang on, dot plot. Here we go. Where the markets at the moment are pricing in the path forward for US interest rates versus what the dot plot is, you can get a little bit of a picture from this screen on the FedWatch tool. And that sort of says to us that effectively the market is pricing in more cuts currently than what the previous dot plot implied. And subsequently, the critical issue is whether the Fed will open the door to what the markets are saying, that this is the path forward for rates, that by the end of 2026, we will get a federal funds rate somewhere in the low 3% range, or perhaps a little bit higher because, the hawkish pivot happened at or not pivot, but the hawkish language came through in October rather than August, which these projections relate to. But nevertheless, this is kind of the picture of where the Fed saw the economy going into next year, according to its last summary of economic projections. To what extent will these be changed or potentially revised higher? If they're revised higher, especially the projection for the federal funds rate, or especially where PCE inflation could be the core number by for the end of this year, as well as going into next. If those are a little bit higher than expected, and we also get some more, a rate cut is not a foregone conclusion style of language like we did at the last meeting, that's going to be the kind of thing that could perhaps upset the apple cart and not support this kind of recovery we've seen in stocks over the last few weeks as markets have priced in this December rate cut. So I think that's the key variable. I think it'll be a hawkish cut. I think that could bring some volatility with it. But I would just direct everyone to keep an eye on these forecasts, almost memorize them going into the decision, see how they change at this particular meeting with the updated projections, and then just keep an eye on where the relative rate paths are for market pricing versus the summary of economic projections to get a gauge on whether it is a hawkish cut or not, or whether it's something entirely different.
Yeah, I think, as you say, it's going to be very important to kind of gauge the tone moving forward. As we know, markets are forward-looking. They want to know what the Federal Reserve is expecting in the next few months, and that summary of economic projection is going to be very important. Any changes to that, to some of those key figures like GDP, like inflation specifically, is going to definitely strike a tone. It's going to be interesting in markets as well to see how they kind of move in the coming days heading into that decision on Wednesday, because we are seeing a little bit of maybe consolidation. Specifically, if we're looking at the FX market, we're seeing the dollar consolidating a little bit, trying to find some support after those heavy losses that we saw last week and the week prior. So it's going to be interesting to see how markets move accordingly. You can see they're just hovering just below that 99 area for the dollar index, actually after having been rejected once again from that 100 level, which continues to be the key resistance heading upwards if the momentum were to change. Kind of looking like a double top pattern there. We'd have to see it break below that Y line that you've got to have there, 98.58, I believe that is. If we were to see it break below that area, you could see that double top pattern potentially consolidating. So it'll be interesting to see how the dollar moves. But I think if you want to pull up dollar yen, I think we've had some interesting data over the weekend or overnight from Japan. Interesting to see that we've had wage data kind of support a hike from the Bank of Japan. For those of you who don't know, we have the BOJ meeting next week. Next week's also going to be a very important week for meetings. We have the Bank of England, ECB, and BOJ. The BOJ being the key outlier here, expected to hike rates, especially after domestic inflation has shown upward pressures. And we've seen wage data from Japan continuing to back that story and to allow or not allow, because they don't really need permission, they need to be enticed, seeing how they move. So kind of suggesting that the BOJ could in fact hike rates. However, at the same time, we've seen disappointing GDP revisions from Japan, actually showing a wider than feared contraction in the third quarter. I think the GDP annualized for Q3 down, showing a contraction of 2.3%, prior reading at 1.8% contraction. So a significant worsening there. It'll be interesting to see how that balance strikes out because, of course, as I've said, the Bank of Japan notoriously known for struggling to tighten their monetary policy. You can understand their view. They've battled with deflation for so long. They are concerned to hike rates too quickly in case they kind of stifle any growth in the economy. But it'll be interesting to see this play out because, as I said, the wage components supporting that hike from the BOJ, but of course that growth factor potentially seeing a little bit of cause of concern, and we're seeing in dollar yen, which is a key pair, we've seen the dollar regain a little bit of a footing after that pullback that we saw over the last few weeks.
Yeah, and there's this talk now that obviously the BOJ could hike interest rates as soon as, next week, and that's been some of the scuttlebutt out there in terms of what policymakers are saying. And I think um, the comment from a waiter last week was that the BOJ will be weighing the case for and against a rate hike. So it's a really fascinating dynamic because the markets aren't fully discounting a rate hike yet. They're not fully discounting a policy rate that could be somewhere in, the contractionary territory or much closer to neutral, because by the RBA, but by the Bank of Japan's own logic, policy remains very accommodative. Policy, in real terms, will probably become only more accommodative going into next year if the fiscal impulse in Japan is as strong as it's likely to be. And if the BOJ was to become much more hawkish, one would expect that the yen would have to appreciate much more than sort of 155 against the US dollar, to sort of reflect again tighter policy conditions. So it's going to be a really interesting dynamic, especially if the Fed cuts and is a little bit more dovish. That the yen has some real two-way risk here potentially, as we go into the new year. Um, but perhaps, Danny, we'll just take a quick look at equities because one thing I wanted to highlight as well, considering we're going into this meeting, and you sort of like briefly discussed this at the top of that last point you were making, was just where we're sitting in terms of equity markets going into the new week, maybe sort of cautiously optimistic. One thing that is very striking is just how low implied probability has become since the kind of sell-off that we saw in equities in the middle of last month. And the perhaps concern that raises that there is a degree of complacency going into this Fed decision, that there is the possibility that a hawkish surprise could deliver something of a breakout in volatility. Not that I trade volatility particularly much, and volatility in the VIX is hard to trade just in general, but it's more or less an inverse of obviously the S&P 500. And I just wanted to note just the interesting daily candle that we finished on at the end of last week, which saw a pretty significant move from the highs and would generally indicate perhaps a loss of momentum amongst the in the market and a diminished strength of for the bulls going into the new week. So my suspicion is that we're ready for a little bit of a volatility shock going into the next couple of days. But one just to keep an eye out for, because we're less than 1% from record highs. All it would take was obviously a dovish Fed to be able to sort of push that higher. But just a curious setup that perhaps indicates maybe a bit of a contrarian setup here, that markets are pricing in the best from the Fed, and not again the kind of two-way risks that potentially the Fed will want to highlight at this particular meeting.
Yeah, interesting. We just got a comment from Daniel come through saying Santa might stay home if it's hawkish. And I think that's a great point because there's a lot of talk about this Santa rally. When December comes, everyone expects stocks to outperform. And yeah, there has been a lot of talk about whether stocks do have enough room to move higher, considering where we are, high valuations, high prices. And as you said, if the Federal Reserve cuts but strikes a cautious tone and suggests that once again markets are getting too ahead of themselves, that could lead to a little bit of a repricing in those expectations. And even though we may see some of that, the cut itself provide a little bit of support. It's unlikely that we see that strong continuation in that bullish trend over the coming week if we were to see that cautious tone from the Federal Reserve. So I think, the Fed's decision and the Fed's messaging is probably the biggest risk to the Santa rally right now, as many are hoping may happen. Kyle, if you want to pull up the chart of gold, of course, another key counterpart to this, and something that we always watch out for, we always get questions about, and it's been very interesting as well, is the precious metal. Because again, expecting to see some further upside in gold if we do see a rate cut from the Federal Reserve. But again, that cautious tone once again could offer some limitations to the upside. You can see there on the daily chart how much gold has been struggling to actually break away past that 4,250 area, more or less. Again, struggling to find further upside and further support along the way. Some sideways consolidations there, likely suggesting that a break is coming sooner or later. I think the direction right now is just uncertain. If we're looking at the path of least resistance in the long term, we've talked about this a lot. Fundamentals continue to support precious metals because of central bank buying, because of diversification, the debasement trade even to some extent. But of course, you've got to watch out for how much potential and how much room there is on the upside, considering where we are right now and the impressive rally that precious metals have had. You would expect that further easing down the line from the Federal Reserve would allow gold to move higher, but it may be a case of drifting higher rather than seeing those strong daily moves that we've seen heading into the end of this year. So again, another very interesting asset to watch out for heading into this meeting, and of course around that messaging, how that can impact the short to medium term in gold.
Yeah, I think the long term, like you said, Danny, still remains fairly constructive just because of, relative to the fiscal impulse, how loose policy is going to be with inflation where it currently is. And that kind of 42.57 is the number that we've got here, but it's probably give or take somewhere between 42.50 and 42.60. That's the kind of resistance level that if it breaks, you might start to see a little bit of buying activity coming through once again. But obviously on the downside, that kind of critical level is probably down below 4,000, where there's dip buys emerged after that kind of pullback from record highs. I wanted to just take, before maybe we get to further questions, Danny, just a comment on the Aussie dollar, just because it has surged recently, and I wanted to just highlight what is the equivalent of the FedWatch tool in Australia, or for Australia, the ASX does its rate tracker tool. This is really fascinating because after a couple of weeks of solid inflation, or a couple of months of solid inflation data, the markets are actually pricing in that the next move from the RBA will be an interest rate hike at the end of next year, and followed by another one in the middle of 2027. So obviously that pricing is liable to all sorts of swings, to all sorts of change. It might be a little bit irrational at the moment. But there's been this really remarkable swing in market pricing away from, discounting more rate cuts going into 2026, subsequently discounting no rate cuts at all going forward. So now we're pricing in interest rate hikes, more or less implying that the hikes, the cuts that have been delivered by the RBA this year, which, there was about 50 basis points thereabouts, may have been a policy mistake. And that's because inflation is reaccelerating in Australia, up at about 3% on the quarterly read, which is the official number. But we also get a CPI indicator monthly because we don't get the full basket, the full picture month on month. We're a bit slow down there in Australia. The indicator data, which is again indicative, suggesting that inflation could be close to 4% and moving higher. So we've got the RBA decision tomorrow. I reckon there is the chance, given how things have moved so quickly, and that the RBA has really emphasized over the last couple of meetings that, again, it's sort of cognizant to both sides of softer labour market conditions, which is actually, in the last couple of prints proving fairly resilient in Australia, while also, concerned about the outlook for inflation and the possibility that, inflation could pick up, which it subsequently has, that it may look to sort of balance the ship a little bit and just discuss the kind of balance between the labour market risks and the inflationary risks going forward in policy considerations. And just like it did try to water down expectations of further rate cuts when the markets were betting on that. Maybe water down some of these expectations of rate hikes into next year as well, and bring it back to a much more even keel. That could be interesting just because the Aussie dollar trades in high correlation with the S&P 500. The markets, like we said before, are pricing in probably a fairly dovish outcome from the Fed, a fairly hawkish outcome from the RBA. If those things don't come to fruition, that the equity market is a bit complacent, that's a little bit of a downside risk for the Aussie. That the RBA won't be as hawkish as the markets are pricing in. That's a little bit bearish for the Aussie dollar. If the Fed comes out a little bit spicy in its language, also sort of bearish for the Aussie dollar. Could be a volatility risk there for the Aussie that's sort of run up to basically what's that, sort of 7 or 8 week highs, and looking like it might potentially move higher. Just want to possibly watch over the next 3 or 4 days as some of this data comes through. So an interesting one from a trading perspective, also interesting one just because the markets are simply pricing in rate hikes, which is quite remarkable given the backdrop we're seeing in other parts of the world, which is all about, other than the BOJ, cutting interest rates, or at least keeping them steady at a relatively low level after a cutting cycle.
Yeah, and we'll talk about more about Europe and the UK specifically next week as we head into those BOE and ECB meetings. However, we will have some growth data from the UK this week. On Friday, I believe we'll have the GDP data, manufacturing, construction, industrial production, all of that data. So it'll be interesting to see how GDP comes in because and this will be data for October. It's a little bit delayed always, but the last reading we had, the month-on-month reading, we saw a contraction in September. GDP dropped 0.1% in the month. Markets are now expecting, or analysts are expecting it to come back into the positive once again, showing a growth of 0.1% in October. But it'll be interesting to see how that data actually comes through, whether we see another negative quarter or even a quarter that shows no growth at all, that 0%. It can reignite those concerns about stagflation, especially because we know inflation remains above that 3% in the UK, of course, way above the Bank of England's target. And if growth continues to show very, very sluggish, it might reignite those fears about stagflation, making the Bank of England's job again much harder. They are expected to cut rates next week. It's pretty much fully priced in at this point. But again, the messaging and the tone is going to be very important, especially not so much about trying to set expectations about the policy rate heading forward, but also just trying to calm nerves in the UK economy. There's a lot going on, I said, with growth, inflation, but also the budget that we saw unveiled the week before last, again, showing that the government has to have a lot of fiscal discipline heading forward because there is that gap that needs to be shut and that needs to be bridged. So it's going to be an interesting time for the UK. Seeing how that data comes through also is going to play a major role into how markets head into that Bank of England meeting next week.
Yeah, totally. We've got just a question here, and then we can maybe wrap things up, I suppose, unless there's more questions to come. Please send them through. It's just, has the fiscal stimulus impact on the JPY ended, and to what extent will Takaichi agree with the BOJ to hike with GDP weakening? The fiscal stimulus impact, I don't think, has been fully played out just because we're still trying to get the full idea of what the shape and size of that stimulus will be. And I think there is a very strong incentive for the Japanese government to continue to spend significantly, not just from an economic perspective, but a lot of this money is being earmarked for defense, as well as other strategic industries that Japan basically needs for its national economic and military security. We're talking about things like semiconductors and other artificial intelligence infrastructure, that the Japanese want to be able to establish for their own economy, not just for, again, the long-term growth and its competitiveness in global markets, but also to decouple from China as much as it can and secure its interest from China. The question about what will Takaichi do when it comes to the BOJ, and there's the interesting one, is that the just unless the BOJ starts to step in and really does table much tighter policy, and perhaps policy that is much closer to neutral over the sort of medium to longer term. And Takaichi going into the elections that saw her become the LDP leader, discussed the need for lower interest rates and a desire from the BOJ to keep interest rates low. As this rhetoric has come through from a Wade or another BOJ official, she has been notably quiet on the subject, and that's allowed, obviously, the yen to appreciate. However, it clearly cuts against her political instincts to um, respect, perhaps, the independence of the BOJ, that if it doesn't serve her interests to stay quiet, that she'll be a little bit louder when it comes to the BOJ's need, in her opinion, to keep interest rates relatively supportive. And given the weak GDP number today, the odds of that start to pick up a little bit. So it's very difficult to predict. I suspect that she'll continue to want to run loose policy, obviously from a fiscal perspective, like she can control, but also be accommodative interest rate policy, which she can't control, but she can obviously try to influence with her language. And that's where sort of some of the volatility risk comes into things. But I think the BOJ will eventually have to step up a little bit. They're forecasting, I think, things that are a little bit pie in the sky for next year, that inflation will basically be below 2%, which, given the fact that it's floating around 3% at the moment, seems to be a little bit ambitious. Already a hike is on the table for next week, so I think that means that the sort of risk for the yen is sort of skewed to the upside. However, once more, this is also a BOJ that tends to be, fairly reluctant to be too assertive with policy. Again, it's dealing with political risk, so there's that two-way risk there as well. But yeah, keep an eye on that space. It's going to be a fairly interesting one.
Well, I think that's it, Kyle. We've been through most of the markets, most of the events for this week, and of course, the key one being the Federal Reserve meeting on Wednesday. As we said, keep an eye out on those the updated projections, whether we see any changes to any of those forecasts, and of course, the messaging around the decision. It's not so much about whether they cut or don't. Of course, if they decide not to cut, that would be a massive message. But if they are to cut, which is widely expected, watch out for the messaging around that, whether it's a hawkish cut, and what that could mean for markets and expectations heading forward. I think that's it from us. Thank you everyone for joining. As we said, this is recorded. It will be posted on our YouTube channel if you want to watch it again. We'll be back here next week to take you through the markets once again. Kyle, thank you.
Thank you, and have a terrific week.
Bye, guys.